Buying gold devalues the dollar, pushes gold up higher, and that's when Judy comes in. And if she's right, and Trump does back the back end of the bond market to gold at a much higher price, in 30 years, we owe that amount to gold. We owe $1 million on a bond that's $1 million. We owe $1 million in gold, zero coupon, no interest. You bring back manufacturing at a zero upfront borrowing cost into a massively devalued dollar, and you pay gold $1 million worth. Well, who knows what it will be back, in 20 or 30 years. James Rickards is saying they want to push it to 24,000. Do they? Will it? I mean, maybe. Who knows? All I'm simply saying is that's how you devalue the dollar. And this is what Triffin's dilemma says. And that's why the knucklehead, Jared Bernstein, one of the silliest guys I've ever seen in my life, try to explain how treasuries are created. He did write a report called Dethrone King Dollar, which said we can't be the reserve currency anymore because it's hollowed out our manufacturing. Triffin's dilemma says the world needs more dollars than we can provide through trade alone. So they sell their currency and buy ours. Naturally, over time, ours gets higher, theirs gets lower, so manufacturing goes to where it's cheapest.
Buying gold is not just a hedge. It actively devalues the dollar and forces a monetary reset. As discussed by analysts like Andy Schectman, a future scenario could involve backing long-dated bonds with gold at a dramatically higher price, allowing the U.S. to repay debt in a vastly weakened dollar. This aligns with Triffin's dilemma, which explains how reserve currency status hollows out domestic manufacturing over time. As global demand for dollars exceeds what trade can supply, capital flows distort currencies and export jobs overseas. Revaluing gold, potentially to levels suggested by strategists like James Rickards, offers a mechanism to reset debt, revive manufacturing, and dethrone King Dollar without default. Now, we present the clips from Andy Schectman's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
Buying gold devalues the dollar, pushes gold up higher, and that's when Judy comes in. And if she's right, and Trump does back the back end of the bond market to gold at a much higher price, in 30 years, we owe that amount to gold. We owe $1 million on a bond that's $1 million. We owe $1 million in gold, zero coupon, no interest. You bring back manufacturing at a zero upfront borrowing cost into a massively devalued dollar, and you pay gold $1 million worth. Well, who knows what it will be back, in 20 or 30 years. James Rickards is saying they want to push it to 24,000. Do they? Will it? I mean, maybe. Who knows? All I'm simply saying is that's how you devalue the dollar. And this is what Triffin's dilemma says. And that's why the knucklehead, Jared Bernstein, one of the silliest guys I've ever seen in my life, try to explain how treasuries are created. He did write a report called Dethrone King Dollar, which said we can't be the reserve currency anymore because it's hollowed out our manufacturing. Triffin's dilemma says the world needs more dollars than we can provide through trade alone. So they sell their currency and buy ours. Naturally, over time, ours gets higher, theirs gets lower, so manufacturing goes to where it's cheapest. Well, Vice President Vance recently said the same thing. It's as if they are purposely trying to massively devalue the dollar by their actions. And so I think really the moral of the story is through all of this, if you save in dollars, you're destined to go broke. And I mean that. And you can measure any asset that you own, measure it in gold terms over the last 25 years, and you will see that in gold, every asset you own, from your automobiles to your jewelry to your home is deflating. It's going down in price massively. Anything you measure in currency, in dollars, Canadian dollars, it's going way up. And you can do that really easily. It's very easy to test. Do it in your house or with a house. In 2000, gold was $450, and the average house in the U.S. was $250,000. It's about 500 ounces of gold. So you could have taken out a mortgage or left the gold under your mattress, earning nothing but dust. Today, the average price of a house is $500,000. It's doubled. Great investment. Your house doubled. But what's gold? That 500 ounces of gold is worth $2.5 million. It buys you 5 houses. So the dollar is dying and gold is not. And that's how you measure the value of your currency, not against a basket of currencies that by Triffin's dilemma says they're all devaluing against yours. It's a flawed measuring stick. The point of it is, through all of this, is I think they understand what they are doing. I don't know how the geopolitical thing pushes into it. And are the tariffs are they just trying to get people to move away from dollars? The only way that this works is if Judy is right, and they do back the back end of the bond market with gold. Now you have real demand for gold, or for our treasury, because it's redeemable. And maybe, I don't know, but I don't know. It's a very interesting time. And just like the Romans, who knows when that last chapter is written? Just like the British Empire, all of the world reserve currencies, none of them really lasted past 100 years. And here we are well past our expiry date. And I don't know. I just think that it's hit or miss. And I'm trying to be optimistic. I am, and maybe there is reason to be. But, you look at what Ray Dalio said, that 60% of the United States has a literacy rate under the 6th grade. Yeah. We're broke. We're uneducated. We don't make anything. And we have, $200 trillion in debt. That's not a bright future for our children. So things have to change one way or the other.
Buying gold inherently devalues the dollar by exposing the flaws of fiat money. As outlined in this argument, a future policy shift, potentially backing long-dated bonds with gold, could allow massive debt repayment through currency debasement rather than default. This aligns with Triffin's dilemma, which explains how reserve currency status destroys domestic manufacturing and forces perpetual dollar creation. Measured in gold terms, nearly every asset, from homes to automobiles, has lost value over the past 25 years, while prices only rise when measured in weakening currencies. History shows all reserve currencies eventually fail, from Rome to Britain, with soaring debt, declining productivity, and monetary expansion accelerating. Gold remains the true yardstick of value and the clearest signal that the dollar's era is nearing its end. Let's get back to the interview.
The U.S. government has classified it a critical mineral. The European Union did at the end of 23. China said in November they're going to prioritize their silver for domestic needs. And then a month later, in response, or 2 months later, in response to us saying it's critical, well, we're going to limit exports. You have the LBMA, which, according to David Jensen, which is someone that I think you should have on your show, he's fantastic, who says there's 2 billion ounces of contracts that are outstanding that are deliverable contracts against a 140 million ounce float. And he questions even that amount. In other words, those 140 million ounces have obligations of 2 billion ounces that they're backing. What could possibly go wrong? You're seeing every single month for the past 15 months since Trump won the election. I'm not kidding. Every month. Millions and millions and millions and millions of ounces every month, billions and billions and billions of dollars. And really, what more do you need to know other than who the hell's doing this? Who is bringing in billions upon billions? And at that level, when you're talking that kind of money, these people don't do things just for the hell of it. They know where things are going. They are friends of or are the folks that make the rules or write the playbook. And when you see a market where 8 Western banks, 1 or 2 in Canada, 4 or 5 in the US, and 1 or 2 or 3 in Europe have controlled the largest short position on COMEX of any commodity ever traded in the history of the market, over 1,000 commodities, that's now breaking. It's breaking because these commodities all have these contracts have delivery features that no one ever did, less than 1%. Nobody did. And it was a market to hedge or to speculate. We use it. If I have 3 million ounces in my warehouse, I'll sell 3 million ounces on paper. So I'm market neutral with my inventory. But what it has turned into is something far more than that. And it has given the ability of the West to suppress gold and silver. And I would argue silver, because of the military-industrial complex, the amount of silver that is needed in high-tech weapons. Go to silverwars.com and read what they say about all of the military uses of silver. And then look at gold, and it's a term called Gibson's paradox that speaks to the inverse relationship between real interest rates and gold. So the West wants to suppress interest rates, they got to step on gold. No one ever stood for delivery, but it started in the global South. It started in 2020, where all of a sudden we started to see huge deliveries and repatriation of gold and silver by central banks and by very large purchasers. It's now accelerating. And when you have, just like Bernie Madoff, everyone was happy with the monthly checks they were getting until people said, you know what, I need my principal back. That's what's happening on the LBMA. That's what's happening on COMEX. You're seeing far more deliveries than there are bars, or far more delivery requests than there are bars to handle it. Far more paper contracts than there are bars standing behind it. That is what is fundamentally different. And I think that's all you need to know is who the hell is standing for delivery for billions and billions and billions and billions and billions in silver. The U.S. government just put a national strategic national security policy floor underneath the price of silver. The public has just begun to wake up, but really hardly at all. They're just beginning to. Not the people watching this this has been common knowledge forever. So this isn't being driven by the retail public. This is being driven by the most well-funded and, far more important, the most well-informed traders on the planet. And they see something very clearly that is allowing them to spend hundreds and hundreds of billions of dollars to bring all this stuff in. They don't do it for the hell of it. Well, you have a tier 1 asset that has no counterparty risk, that has doubled the performance of the 10-year Treasury over the last 25 years. And look at it the last few years. Last year, gold's up 40%, the Treasury's up 4.5%. And they had just got done, sanctioning Russia and confiscating theirs. This last year, gold's up 80%, 10-year Treasury up 4%. That's 20 times. So the point of it is there's no counterparty risk. It outperforms it. I think that is the difference, is that you have countries that are saying, we have enough money. You can't do that to us. You can do that to a hedge fund or to some traders. Go for it. Try doing it to the People's Bank of China, or try doing it and a sovereign-based hedge fund that works on their behalf, or try doing it to Saudi Arabia or to India. Any of these big countries have pocketbooks and checkbooks and intellect and coordination and motivation and sophistication that they didn't have, or the desire to challenge the West. And this is the way to do it, to challenge the West in a very docile way, if you will. And you don't need to fire missiles and bring your warships to the coast of New York to threaten the U.S. You just need to create an event where you get one of these massive banks to failure to deliver. And I think that's what's happening also right now with the European banks, because they're the ones supposedly on the hook. Now, that's Tom Luongo's theory, but if you look at a report that just came out of the Economic Times, they claim that JP Morgan has flip-flopped and has went long, has covered a 200 million ounce short position in silver, bought 21 million ounces over the last 6 weeks of physical, and largely they and the rest of the U.S. banks, the big five, are long, leaving one or two of the banks in your neck of the woods and a couple in Europe massively short. So as the price goes up, who is getting squeezed on? This is a very different deal than it was in 2011. This is about national sovereignty. And when you have the European Union, the United States, and China effectively say that we are rushing to accumulate this stuff and classifying things as critical and openly using it, like the BRICS are, as a settlement vehicle instead of treasuries, in other words, use gold to settle imbalances in trade and in currency. That's part of the M Bridge. That's part of what they're doing with the expansion of the Shanghai Metals Exchange. They're opening vaults all throughout the Belt Road. The first one was built in Hong Kong, where if gold leaves China, has to come out of Hong Kong. Well, the way they're doing it is they're trading their digital yuan over the SIPs or the M Bridge to a country like Saudi Arabia, getting their oil, and that digital yuan is now immediately convertible into gold off the Shanghai Gold Exchange in Hong Kong without converting to dollars. Guess where the second exchange is being built? Saudi Arabia. And they plan on doing multi-jurisdictional vaults all throughout the Belt Road, creating a system where you trade in local currencies, settle imbalances in gold. Gold is being integrated into the monetary system globally, and silver's is flat out critical for a world that is advanced. And I think they are prioritizing that now. And that is what's different, is that now it's not as big of a secret to the people who are pulling the strings as it once was. And these countries are significant enough in wealth and in sophistication to challenge this hegemony that where no one stood for delivery. And if you do, you break the system. And that's starting to happen right now.
Silver has quietly become a strategic flashpoint in the global monetary system. The U.S., EU, and China now classify silver as a critical mineral, while China has restricted exports to protect domestic supply. At the same time, paper markets like COMEX and LBMA show extreme leverage, billions of ounces in contracts backed by a fraction of physical metal. What's changed is delivery. Sovereigns and state-aligned buyers are standing for metal, not cash settlement. This shift threatens decades of price suppression controlled by a handful of Western banks. With gold increasingly used in trade settlement and silver vital to defense and technology, physical demand is challenging paper promises, turning silver into a matter of national sovereignty, not speculation. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.